A new report from Fannie Mae is downgrading the economic forecast for the United States, as well as downgrading the housing outlook or the housing market outlook over the next couple of years. This report was just released today at the time of this video. So with that said, there's a lot of information to go over in today's video. So let's go ahead and dive right into the video and this press release from Fannie Mae. It says here, housing activity expected to slow further as affordability worsens in the United States. This is just released today at the time of this video, the 19th of May. So Fannie Mae has an economic and strategic research group, or their ESR group, and they forecast the housing market and the economy every single month over the next couple of months. So here's the latest stats they have to share regarding the housing market, because they become very bearish regarding the housing market. They are downgrading their forecast from their previous forecast that we saw here just about a month ago. It says this group expects a meaningful slowdown in home sales for the second and third quarters of 2022. A significant slowdown in home sales. This is going to be followed by a softening in construction activities and ultimately a large deceleration in home price growth. With mortgage rates having risen faster in the last 5 months than any other period since 1981, the group expects both purchase and refinance originations, or the amount of people doing refis and purchases for loans, is going to decline meaningfully. Meanwhile, rising mortgage rates are reducing affordability through higher mortgage-related costs, all while home prices continue to grow. Historically, though, rapid and substantial rises in mortgage rates have had the effect of slowing activity, which we reflect in our housing market forecast here. Not only is the worsening affordability of houses a problem for potential entry-level home buyers, but current homeowners are less likely to trade in their existing lower rate mortgages and list their houses for sale, both of which will likely weigh on home sales. So they're basically saying that we're seeing rising mortgage rates, and that's going to be causing fewer home sales because more people are going to be priced out of this housing market. On top of that, a lot of homeowners who have mortgages of less than, or mortgage rates of less than 3% may not be willing or may have low motivation to get their houses listed for sale because mortgage rates right now are approximately 5.5%. Why would you sell your house when you have a 2.6% mortgage rate, right? And also we have record high rents as well. However, when we actually look at the data itself, here's the latest stats we have for you guys. This is according to Redfin. This dark line right here in black is for 2022. And these are for new listings that hit the market each week. And this is for the 4 weeks ending May 16th of this year. So as you can see here, for the 4 weeks ending May 15th, the number of new listings is basically on par with 2021 and 2019. We started the year basically at the same levels. We started to peel away though back in March, where the increase of new listings was not on par with 2021 or 2019. However, right now, the number of new listings is only down by 0.6% compared to 2021. Compare that to the 4 weeks ending April 17th, we were down 6.8%. So basically we're flat for the number of new listings. So basically we're on par with the last couple of years, which is obviously a positive sign if we want to see this housing market slow down and for more home buyers to have more options. So we're starting to see increase compared to prior years. We'll have to see this trend continues though, given the fact that we still have favorable conditions for home sellers. We still have a strong sellers market overall in the United States right now. So have a look at this too, because here's active listings, which is another word for housing supply, the total number of houses available for sale in the US. As you can see here, this line right here is 2019, this is 2021, and this line right here is 2022. Ignore this line here because these are just percentages here. Actually, let's move up here. So 2022 right here, we're down 14.81% compared to 1 year ago. So we have approximately 565,000 houses for sale in the US at the time of this video. But as you can see here, look at the trend this year compared to last year. So basically we started this year at 545,000 houses for sale, and now they actually have increased that to 565,000 after reaching all-time record lows back in early February. But as you can see here, at the beginning of the year, we were down 21% for housing supply compared to the first week of 2021. So again, down 21%. Now we're only down 14.81%. So the gap between 2022 and 2021 is shrinking. So we'll have to see if this trend continues. And if it does, we may see housing inventory be at higher levels later this year compared to 2021. In any case, going back to Fannie Mae's forecast here, they say housing feels stress of rising mortgage rates as inflation weighs on consumer spending. Home sales turned a corner over the last quarter as we expect a further slowdown over the coming months. Mortgage rates have continued to rise and are now at the highest level since 2009. As you guys all know, mortgage rates have been fluctuating around 5.3 to 5.6% over the past couple of weeks here, and that is the highest level since approximately 2009. Here's a big takeaway for you guys though. It says, we forecast a continued slowdown in home sales to be followed by a softening of construction activity, and lastly, a large deceleration in home price growth. So have a look at this. This is the latest forecast that they posted on their website today. So here's total housing starts on a seasonally adjusted annual rate. And by the way, these are in thousands of units. So as you can see here in 2021, we were at very elevated levels. For the first quarter of 2022, we were at 1.7 million total housing starts. I believe that was the all-time record high, or very close to 1973 levels, if I'm not mistaken. But look at their forecast, which is the gray shaded area here. For Q2 of 2022 of this year, they're forecasting that total housing units or total housing starts on a seasonally adjusted rate is actually going to be less than a Q1. And as you can see here, every single quarter after that, they're decreasing their forecast for total housing starts. So total housing starts as a benchmark for 2021 increased by 15.8%. What they're forecasting though for 2022 is only a 0.1% increase compared to 2021. So they're forecasting that housing starts are basically going to be flat compared to 2021. However, look at this, 2023, they're forecasting housing starts to decrease by 19.4% compared to 2022. And here's a breakout of single family and multifamily. As you can see here, single family houses, the housing starts or their forecast for housing starts is decreasing every single quarter. And also for multifamily as well. I'm actually surprised by this because as I've been reporting to you guys, builders have been ramping up housing starts and construction of multifamily properties, especially 5 units or more. These are for apartment buildings to rent out. However, Fannie Mae is forecasting for a decrease every single quarter going into the last half of 2023. So multifamily is going to be increasing by 6.5% in 2022, but a big decrease by 18.3% in 2023. And also for single family houses, a decrease by almost 20% in 2023, a big decrease there. And total home sales, they also are forecasting for home sales a decrease by 11% this year, and also again by 11% in 2023 compared to 2022. In regards to mortgage rates and their forecast regarding that as well, here's something very interesting as well. So the average 30-year fixed rate mortgage was fluctuating around 3% in 2021. However, look at their forecast for 2022. So for Q2 of 2022, they're forecasting that to be 5.1%. Q1 was 3.8%. But look at that. They're forecasting that mortgage rates are basically going to be flat going into the last half of 2023. So their forecast calls for an average of 4.8% for 2022 and a 5.0% rate for 2023. Meanwhile, the forecast for 5/1 ARMs is forecasting to be 4% in Q2 of 2022. So basically a spread by 1.1 percentage points compared to a 30-year fixed rate mortgage. However, they are forecasting that spread to thin. So by the end of Q4 of 2023, they're forecasting that that spread to be 0.6 percentage points. So it says here the shock to home buyer purchasing power has been immense. So for every 1% gain in mortgage rates, that causes a 10% decrease in buyers' purchasing power. It says the latest reading of the 30-year fixed rate mortgage, according to Freddie Mac, was 5.3%. That's up 219 basis points or 2.19 percentage points from late December 2021. This is the fastest rate of increase for a short period of time since 1981. We estimate that the monthly principal and interest payment required to purchase the median price home in the United States has risen by more than $500 over that time frame. with the majority of that change occurring since February. So basically, to buy the same house now compared to December 2021, you should expect to pay approximately $500 more in principal and interest payment, excluding property taxes. So obviously, because home prices have increased greatly, you're also going to be seeing an increase in property taxes as well. So comment below with your biggest takeaways from today's video. Also, if you got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Hope you have an awesome day and look forward to seeing you on the next video.